Hey, what's going on, guys? This is Michael with Imperative Finance. So in this video, we're going over part 2 of the real estate pro forma. We're looking at before tax cash flow specifically. So if you don't know, I've made an overall video of the entire pro forma in full detail. I've gone over part 1 in last video, which is just the NOI segment. And then in this video, we're going over before tax cash flow. So if you're unfamiliar with a pro forma, I recommend watching those videos first and then coming back to this one to see how this segment breaks out. So with that said, guys, let's hop right into it. Once again, I'm not going to go into the full deal metrics here, but effectively, again, purchase price $200,000, $160,000 loan amounts, and a down payment of 40 grand. And you can look at the loan terms and all that here if you want to, but effectively, this is what we're dealing with. So the pro forma, again, we left off with NOI. So gross rental income, we took out vacancy, added other income, we got to effective gross income, we took out operating expenses, and we got to NOI. And we were able to get certain returns based off those figures. Now we're in part 2, which is before tax cash flow. So the way that before tax cash flow works is you start with your NOI, and then you take out your one-off expenses. What are one-off expenses? Well, this could be anything from leasing expenses, which we're going to move over to the pro forma breakout here, the full detail. Don't let this scare you, but to go into detail about what this could all consist of. So when do one-off expenses occur? Well, in terms of leasing expenses, this occurs when you're trying to lease out the property, right? So if you're trying to lease out the property, let's say that the tenant moved out, you might have some marketing materials, some one-off marketing materials that you have to purchase. You will have leasing commissions more often than not in a commercial setting. You'll have tenant improvements in a commercial setting, and you may have any other expenses such as legal docs, administrative, that sort of thing to draft documents, anything to get the tenant into the space. That is called a one-off expense, and I would call that leasing, anything that has to do with leasing the property, all right? Now, how do you predict that stuff? Well, obviously you work with a leasing agent, and you'll have fixed fees. There may be some marketing material charges. The tenant improvements would be dictated by the actual tenant. What are his needs or her needs? And effectively, they might say, we want this XYZ, we want this build out, and you have to price all that out and basically come to an agreement within the lease. Then other expenses, anything else that has to do with getting the tenant into the space, that would fall under this category. In this model, this is a single family home model, so I'm not actually predicting anything for these, but that's the way that you would actually predict that. Now, let's move into capital reserves, capital expenditures. So this gets into some muddy water. You know, this is where a lot of confusion starts to arise in terms of pro formas and the way people build them out with real estate. So I mentioned this a little bit in the last part, but I want to mention it again, is that you might see some people try to argue that capital expenses will go above the line. What does above the line mean? Well, when you hear above the line or below the line, what the line is in real estate terminology is NOI. So from the traditional financial perspective, what you'll see is that you have a difference between operating expenses, which are basically recurring expenses to operate the property. And then you'll have capital expenditures, which is your one-off expenses. You know, you have something break, you have to replace an entire roof, an entire water heater, that kind of stuff is a capital expenditure. So the reason that's not included up here is because the net operating income is supposed to show you net operating income. It's not supposed to show you all of the costs associated with, or that could possibly be associated with, that property. All right. But some people will argue, and it's not wrong necessarily to do this, but they will throw CapEx up there. It's wrong in terms of traditional finance, but it's not wrong from the perspective of, okay, well, if I'm allocating, in this case, $2,000 a year to capital reserves, then I should be including that in my NOI because I'm not taking home 17 grand in actuality. I'm actually taking home 17 grand minus my capital reserve that I'm allocating each year. So I'm left with 15K. Well, for me personally, I'll look at my cash flow before debt service. That's what I'll look at. I don't want to put that above NOI because I am a stickler for rules. I keep it like this and it makes it more simple. Now, what you'll see here, I want to make a distinction between capital reserves and capital expenses. Capital reserves is effectively just a way that we project out capital expenses. So rather than saying that in year 1, we have 0 capital expenses, 0, 0, 0, and then boom, we're hit with 10 grand. Year 5, well, that's going to mess up our cash flow projections and all that, even though in actuality, that might be the case. But to cover ourselves in terms of understanding the annualized return metrics, we're going to use capital reserve rather than capital expense, at least in our pro forma. So there's the difference, right? This pro forma is just a way of projecting out annualized returns versus an actual income statement. You will show capital expense and you'll show yourself actually paying expenses as they occur. Now, I want to make another distinction and a clarification in this video because it's also one that confused me a lot whenever I was first starting. You can have a reserve account for repairs and you can have a reserve account for CapEx if you so please. Another way to do it is to have one account. And from the lender's perspective, they want to know how much total reserves you have in correspondence to PITI, principal, interest, taxes, insurance. So you add all that up and they want to see a certain percentage in your reserves. Oftentimes, it's 6 months worth of reserves, or it can be something like 12 months. I mean, it could be really anything, but the average I'd say is 6 to 12 months. but obviously check with your lender what they want, but it's good to have that reserve account. Now, something else to note about CapEx and repairs is that over the course of your portfolio growing, as it grows, you will probably need more and more reserves for your repairs because ongoing repairs obviously are ongoing. They're operating, so they're going to be more often than a CapEx. But what's interesting is that the more properties you acquire, the less you really need for CapEx reserves. You know, it's not really a one-to-one thing when it comes to CapEx because these units will break less often, right? A water heater is going to go out every 10 years. And so it depends on the makeup of your entire portfolio, but oftentimes you won't need that much CapEx in there at one time. Now, it might still be wise to put aside all that money so that when the time does come, you have the money. That's just my personal way of doing it. Now, how do you actually predict CapEx? What you're gonna do is go over to a different column here, a different tab, and basically map out all of the different replacement costs. So shout out to BiggerPockets, by the way, for this little table. I have not done this table for this property. I've just used it as an example for this video. But effectively what you will do is you'll have a capital expense column and you will map out all the different items that go into CapEx. So all the ones listed here are the ones that BiggerPockets says are typical. And I would agree with this definition. So you have the capital expense line items, then you have your replacement cost. How much does that unit actually cost to replace? So I would literally go around to your different pieces of equipment in your house or investment, whatever your investment vehicle is. And I would look up the SKU model, look up the price and get a price that way. Then I would look at the average lifespan of that model. And then I would get a cost per year. You divide that out simply just by the replacement cost divided by the lifespan. And then you'll get an average cost per month based off that expense item. Then you add it all up and you have a total CapEx expense account that way. So once you have that, you have what's called your cash flow before debt service. All right. Now, cash flow before debt service, once you add in the debt service, that's when you get to your before tax cash flow. So how do you add in debt service? Well, debt service is composed of two things, your principal payments and your interest payment. I like to personally show this broken out on my pro forma because it's important for me as an investor to see later on for after-tax purposes what kind of portion is going to principal, because obviously that portion is not depreciable, but interest payment is used as a depreciation expense. So we'll use that down here in part 3, which will be the next video. So the way that you do this, again, is have a loan amortization table. And then for this exact model, this is year 1. So for year 1, it's just summing everything in the loan amortization tab for interest, right? So year 1 is all that, boom, 9,546. Over here, 9,546. This is rounded out. So with that said, that gets you down to before tax cash flow. Now, at this point, jumping back to the summary here, we've gotten this, before tax cash flow. Well, what does this tell you as far as returns go? Well, there's two very important return metrics that a lot of investors look at, all right? The first is your actual cash flow. What is your dollar amount that you're getting back per month or per year? So a lot of people like to see $100, $200, $300 per unit on the rental properties. But again, it's really your personal investing strategy, your personal investment. What is your risk tolerance? What is all those different figures for you as an investor? So again, though, this is just the cash flow annualized. So this is just copying what's down here. That's your annual dollar return amount, cash-wise. Now your annual ROI is composed of many things, but first off, it's the cash ROI, the cash on cash return, right? So let me jump over to another model which shows the formula for you kind of broken out. The cash on cash return is effectively just your cash flow divided by how much you have total invested into the property. Some people calculate this based off of, again, how much they actually put into the property itself. I personally think that it's a smarter and more appropriate way to calculate it based off how much in total did it cost me to make this investment happen. So that would include your closing costs, right? So for me, I have the total investment, the total amount of dollars it took for me to make this deal happen. So with that in mind, again, take your cash flow divided by that 45,000 and you will get a cash on cash return or cash ROI of 7%. So many people would agree that a good deal, especially in today's market, would be around 8%. Really good deals would be 12% and onward. I mean, that's kind of the general range if you're looking for a cash flowing property. So that's one metric that's very, very important to look at. And I want to make the point in this video as well is that when people say, oh, the most important metric in real estate is the ROI, most people, when you hear them say that, just know they're talking about the cash ROI, the cash on cash return. But for your understanding, understand that ROI is consisted of every way that you make money in real estate, which is not just the cash ROI, that's one of them, but the total ROI would also include your principal paydown ROI and your appreciation ROI, all right? When you add all those three up, you get your total annual ROI. Again, just a minor discrepancy there, but just know that that's what most people are talking about. When they say ROI, just know that they're talking about cash ROI or cash on cash return. And the reason that's the most important is because that's the actual realized gain that you have when over the whole period of this property, right? So if you hold it for 5 years in this case, you will realize a 7% actual return, right? That is your actual realized return. and it will be subject to taxes, as we'll go over in the next part. Now, same thing occurs with something called the cash ROE. So the return on investment, I would argue, is more important, and most investors would agree that it's more important, but the ROE is also important to look at because, as you'll notice, the ROE is going down in this case. That's because this is a cash flowing property. So even though the cash flow is improving each month and each year, which is very, very good to see, the ROE is actually going down. Well, why is that? That's because your equity, total equity buildup you have in the property, going up drastically due to the appreciation assumption that we have in here. This is a 3% increase in home value assumption per year. And so what that means is that the equity we build up in the deal is quite substantial. So what does that happen? What does that mean? That means that the denominator of our equation here of ROE, which is your cash return divided by the total amount of equity in your deal, that's going down as you hold the investment. So what does that tell the investor? That tells the investor that I need to redeploy this capital, move it out of this property, put it in a different property, and therefore I'll actually make a higher ROI on my money, right? So what's important to understand about this is that if I take that equity out, my ROI, my cash on cash return is not affected, right? So I can move that money out of that property, put it in a second property, and effectively have a second property also bringing in 7%, 8%, 9% per year. And so I've effectively doubled the amount of ROI that I'm getting from just by removing that money, redeploying it somewhere else into a different investment. So, and what else will that do? That will increase your ROE. But again, it will not decrease or affect your ROI, which is a very important distinction to understand. So with all that said, what is a good ROE? Well, a more important question, most investors don't care about what the actual ROE is. It's more about, is my ROE going down? And if that's the case, how can I redeploy my capital, like I just mentioned, to increase my ROE on this particular investment? So to keep the ROE high, you have to take your equity out of the deal. So that's what a lot of investors end up doing. With all that said, guys, thank you so much for watching this video. That's gonna be it for today's part. Next video, we will go over cash flow after tax, which starts to get into depreciation, and there's some little tricky components of that. So definitely stick around for that video. And yeah, with that said, if you enjoyed the video, leave a like down below, subscribe to the journey, and make sure you leave your comments down below in the comment section. If you have any questions, I'm happy to address them down there. Thank you so much for watching, guys. Have a good one. I'll see you in the next one. Peace.